Welcome to a series on common chart patterns used in technical analysis. Examine these patterns in action before, during, and after they develop important events on the chart. Understand features and variations associated with each pattern. Watch a variety of situations, including how the pattern can conclude successfully, and see scenarios where they fail to produce their expected movements. Through the use of dozens of real chart examples, we will see advantageous and disadvantageous conditions for the use of chart pattern analysis. There will be a wide selection of charts from various time ranges. So no matter when you watch this or which particular charts you choose to apply chart pattern analysis on, the information presented here can still generally be useful for you. First up, technical analysis with the double top chart pattern, which won't always take the shape of a horizontally flat square or rectangle. It's not unusual for the upper or lower boundary to have a slight slope. Ideally, the two down swing points would form a distinct and leveled M shape. Here, the two down swings are not full swing points, but rather two pairs of large candles that form the same general shape. This is quite common when patterns take place in a more narrow range like this. And even though the pattern concludes successfully for a bearish reversal, it's also not unusual for the chart to stall and remain relatively flat around the bottom range of the double top before and or after dropping below the lower boundary of a double top range. Here's a double top with full and sharp distinct swing points. The pattern outlines centers around the real bodies and closing prices of candles, but don't forget to reveal a more complete picture by also extending the boundaries to the highs and the lows. As expected, when returning back up to this range, there is resistance upon contact. And during more neutral to bullish phases, candles still tend to concentrate near these levels when in contact. The same can apply when the range's role is reversed to support. Just look at all those closing prices concentrating in the upper 20 range when the chart falls back into it in July. On the next chart, it appears the 139 to 141 range is already a major long-term range that has provided significant support and resistance. This could fit looser criteria of a double top. The second downswing point isn't aligned in that historic range, and extending down to that clear upswing point produces a declined double top that's quite a bit larger than normal. So some may just consider this two down swing points that each produce their own moderately sized downtrends. Here's an example of lots of swing points not directly related to the main outline of this likely double top range. Incidentally, down here, a double bottom defines the lower boundary. Altogether, this forms another larger, wider double top range, indeed more leveled and well aligned along with a larger drop. Upon completion here, there's more volatility and not so clean of a break. Such situations make it more difficult to discern if the pattern has completed, since there are quick and wide variations moving the chart above and below the lower boundary of the double top range. Even when there's a strong uptrend like this returning back into this resistance range, the uptrend will still briefly slow down in the short term, such as at these areas. Later, when this area returns to being a major support range, there are clean bullish reversals around it in the short term, as seen with lower wick rejection when most of the candles form to produce that double bottom reversal. Next is another demonstration of a highly compact double top, defined by a few candles rather than full swing points. A similar situation here with the next double top, which is slightly larger but still mostly defined by candles instead of larger swing points. We can take note of the minor decline for the upper boundary, but it's not a major feature. And just like before, the chart returns back up with a strong uptrend, which will still encounter at least some minor resistance in the short term. From the simple double top patterns forming, we are presented with lots of useful levels and ranges that tend to remain relevant in the long, medium, and short term. Next, the double bottom chart pattern, which is such a common bullish reversal pattern that it's not too extraordinary to see situations like this where double bottoms can be connected together by sharing some common levels. It's also possible for double bottoms to neatly form within the exact same range as previous double bottoms. Interestingly, this next double bottom centers around the middle portion with the downswing made up of a gravestone doji and a large red candle. The second half of the pattern isn't made up of a full swing point, but rather just those two candles that rebound from the 140 to 139 range from the previous upswing point. The upper boundary is extended up to 143 due to the long upper wick in the middle from the gravestone doji. The distinct outline of the W shape can be seen more clearly by just looking at closing prices. In any case, the pattern finishes quickly with that one large green candle closing well above 143. Then, as with any successful double bottom reversal, the chart keeps closing above the upper boundary at 143, which will continue to mark a major area of support well into the future. Here's a similar situation, except the first half of the pattern is where there isn't a full upswing. but rather just two medium to large size candles that span most of the double bottoms range. Again, looking at just closing prices outlines the W shape more clearly. 1722 defines the upper boundary. It runs through the upper portion of the real bodies for 4 candles in a row to define the first half of the pattern. Then when the pattern finishes, it's relatively quick as well, with strong closes higher during the formation of a quick 3 methods rising candle pattern. Later, there's a bearish retracement to this steep uptrend, which is gradually reversed with the development of this area, which could still be considered a double bottom that's more spread out and comprised of flatter upswing points. To further validate this range, you can see the levels are highly influential before and after the double bottom. This actually makes up the middle and bottom portion of a larger double top. Later, when 1790 is recontacted, there's a compact double bottom similar to what we've seen in previous examples. Over here is the opposite situation of what we saw earlier. It's a larger double bottom with clear and sharp upswing points. In between them is a small double top reversal defining the middle and upper portion of this bullish reversal. Once there's that characteristic conclusion to the pattern, when there are strong closes above the upper boundary with larger green candles that are often part of 3 methods rising and 3 marching soldiers candle patterns. Here's possibly one of the most compact double bottoms possible. However, it still has those 3 key points that construct the main outline of the pattern based on closing prices. Again, the range can be expanded to be more comprehensive by going up to the highest high and down to the lowest low. Sometimes when the outline is made up of candles rather than full swing points, the chart may not fall back into the exact same range, but it can get quite close. Over here, a slightly less compact double bottom, but one that has more well-defined swing points. When the chart soon drops back into the same range, another double bottom forms. It presents a noticeable incline. Then the extra bullish sentiment is confirmed. Essentially, this makes a double-double bottom, where each swing point is a bullish reversal area made up of one double bottom pattern each. Moving on to the triple top chart pattern. In this case, even though there are 3 downswings relatively close, there's an incline before and near the end of this relatively horizontal range to add similar characteristics to an ascending triangle pattern, leading to the failure of a triple top reversal. In any case, the range running through the 3 downswing points is still useful, mostly to reference resistance during this pause in the larger uptrend. Here's another variation to the triple top, sharing some features similar to an ascending triangle, except one that would be flipped horizontally, meaning it has quite a level upper boundary and a noticeable decline to the bottom portion. It could be said this decline represents additional bearish sentiment, but those upswing points can still be used to identify a horizontal range similar to a more rectangular triple top. Overall, there's still the characteristic steep drop below the lower boundary of this triple top. Then the entire range from 93 to 95 naturally sees down swing points form immediately after the pattern completes, and well into the future. On this next chart, the downswing points have more variation, but are still quite level and aligned with each other. Like the first chart example, there is an incline, but it's not as significant on this one. There's a distinct break of the lower boundary for this triple top range, essentially with a large 3 methods falling candle pattern due to higher volatility when the bearish acceleration takes place below the lower boundary of this range. Here's a more compact variation of the pattern in a more typical rectangular range. In addition to the closing prices, even the wicks of candles are fairly horizontally level. Again, the pattern concludes strongly with a 3 methods falling candle pattern breaking the lower boundary. A fairly compact triple top range with sharp and clear swing points to easily outline where the bearish reversal begins. Yet another triple top range sharing similarities to a failed ascending triangle, the lower boundary is again defined by the lowest upswing point. And notice this time, just before the pattern completes, there's a downswing point that isn't as closely related to the triple down swing points that form the main pattern outline, giving it a quality similar to the right shoulder of a head and shoulders pattern. Even with these differences, the upper and lower boundary of the triple top reversal form a range that remains highly relevant for a long time. For example, there are clear double bottom patterns forming around the range. Here's a fully declined triple top where the lower and upper boundaries are both declined. Basically like a small shallow channel rather than a flat, horizontal rectangle over here, a clear M-shaped double top reversal that's in the same range as a relatively recent downswing to produce a more spread out variant of the triple top pattern. Here's another example with a closer look at its development naturally. It tends to be a bigger range, wider both horizontally and vertically. This spread out triple top is in more of a bearish continuation context rather than being the main bearish reversal. Also, despite the relatively wide range, these levels are still quite precise, as upswings and downswings neatly form around them. On to another case where a long-term downtrend has a bullish retracement that is ended by a triple top. This time, it's a much more ordinary and compact rectangular horizontal range. There is more variation with the closing prices of the downswing points, but they basically line up together quite neatly when considering their upper wicks. Additional bearish sentiment is represented by the bearish candles that form each downswing point. Next, the triple bottom chart pattern, which in this case defines the reversal of a deep retracement that's quite large, even though it's not the main bullish reversal pattern for the larger uptrend that began during the formation of the double bottom back here. On the next chart is an example of the triple bottom with a declining lower portion, but nonetheless, the upswing points still have enough overlap of open, high, low, and close prices to define these levels of support. And it's even more straightforward with the top portion, which is already horizontally aligned. This 1025 to 1033 range has already been significant in the past, with it offering support, and more recently opposing the final phase of the drop for a brief period during the formation of that three methods falling candle pattern. Indeed, it's a quick conclusion to the pattern. There's a fast series of consecutive closes above 1033 to accelerate the uptrend much higher in a relatively short period of time. After a moderate retracement is halted, we get this, one of those situations where there's a pattern that's technically a reverse head and shoulders pattern, with the first and last points being horizontally aligned while the middle upswing point is slightly lower to form a slight difference from the normal triple bottom pattern we've seen so far. It's a minor variation and not that important, but something to point out. More importantly is the upper boundary, which is a clear horizontal level for a triple bottom or a reverse head and shoulders that has a quick series of closes above it to accelerate the uptrend that has sharply reversed, and will naturally encounter stronger support potential when falling back onto this same range. Over here, two upswing points with relatively medium to small candles that are quite horizontally level with each other. The same could also be said about this one because, as usual, when outlining a pattern, attention is often concentrated around the real bodies of candles rather than the wicks. Indeed, the lowest closing prices at these swing points are quite level. Here's a demonstration of an upswing point that isn't part of the main triple bottom outline. It's an acceptable variation, which doesn't happen as often, especially if the triple upswing points are part of a more rectangular horizontal range, which isn't the case here considering how these downswing points are oriented. As a result, the upper boundary, and by extension, the entire formation of this triple bottom becomes significantly wider. But nonetheless, the clear swing points from this bullish reversal range still turn out to be highly influential on the chart for a long time. Not much different from a more standard triple bottom reversal. In other words, that classic and distinct outline of the capital letter W. Here, the ranges of the lowest candles for each swing point are quite level as well. The closing price for the middle one is slightly higher, but that's okay because its lower wick is essentially overlapping almost all the range from the first and third upswing points. Such a minor deviation is okay. It doesn't have to be a situation where closing prices and the ranges of the candles are perfectly horizontally aligned, like with the case of the two downswing points defining the upper boundary. In fact, it's even good to see the second upswing point is a bullhammer type candle to demonstrate bullish sentiment in the shorter term as well. Then, as usual, this triple bottom range will be an excellent reference for a future support, the quality of which can be seen by how candles form open, high, low, and close prices very close to these levels. In particular, how candles tend to rebound and close at or above these levels. Since this range holds firmly despite the fact double and triple bottom ranges failed to decisively clear over the 1955 level, the support range remains quite strong, never dropping below the 1880s. So it's not too surprising when a more defined uptrend eventually develops. As for the ascending triangle chart pattern, here's a case where the pattern forms almost immediately after a bullish reversal, really accelerating the progression of the uptrend and marking a major long-term range of support from 71 to 72, which won't be recontacted anytime soon with the completion of another ascending triangle. In addition to the main incline of the triangle, there's a steeper short-term uptrend line just as it begins to complete. All these uptrend lines have some influence, but overall aren't that useful in this case, in terms of providing references for support, which of course is done much better by the 76 to 77 range from the resistance area of the ascending triangle. After eventually dropping below this firm support range, it reverses roles to become clear resistance, which pushes the chart back down to where even the first range in the low 70s becomes relevant once again. Looking back more closely, there's a third ascending triangle right on top of the second one, demonstrating just how stable these steep portions of the uptrend were. The next example begins with a double top, which marks a clear resistance range now reversing roles to offer support. A fairly horizontal range is developing, especially at the upper boundary near 30, but there likely won't be a triple top pattern since there's a gradual yet noticeable incline now, with the upswing point slowly rising off the old double top range from 28 to 29, leading to an ascending triangle that's likely to conclude soon. Watch it closely, and the result is a clear drop below the triangle uptrend lines to demonstrate a case of a failed ascending triangle, which in this case doesn't lead to a complete uptrend reversal, as the support range from the old double top and the lowest point of the ascending triangle now provides firm support. Then when returning back to the 30 boundary, there's also some resistance when recontacting the trend line, as well as the horizontal range, which is gradually being surpassed. It's not a strong break, as the chart quickly falls back onto these boundaries, where support is turning out to be under significant pressure as the trend line and this range begin to see the appearance of consecutive 3 methods. Falling candle patterns that return attention back to the old 28 to 29 range to finish off a good demonstration where an ascending triangle does fail and leads to a bullish to neutral situation, rather than an immediate switch to a downtrend falling out of the ascending triangle's boundaries, which still hold to form somewhat of a horizontal trading range. To the next example, starting with a moderate to deep retracement rebounding with a double bottom, then going fairly flat and range-bound that has recently seen an upward slope emerge to put steady upward pressure on that clear resistance range, which leads to the characteristic break of an ascending triangle quite quickly. There is a strong downswing, which in this case does see the trend line and the support range hold. A few highly bullish candles also make a big difference to transition the range centering around 170 from firm resistance to key support to accelerate this uptrend much higher. Now the descending triangle chart pattern, which in this case produces a textbook example of a strong bearish continuation. Now here's a double bottom that has its uptrend steadily reversed. The stable decline connects with the double bottom range, which can be reused as a wide base of support for a descending triangle now. In this next example, there is the general shape of the descending triangle pattern. The main difference is it forms to reverse a trend, rather than the more common context of it being a bearish continuation. When the pattern is out of context, it could be less reliable, but not in this case. Since the pattern is clear, concise, and made up of large candles, most noticeably and important at the area where the support base is broken through, it still provides a good landmark for a bearish reversal. So naturally, these levels can be reused to reference resistance quite reliably, similar to a pattern like the double top, which incidentally forms quite close to the 1935 and 1910 levels. Speaking of double tops, the next example begins with 1. The horizontal range of this double top smoothly transitions to a descending triangle. So it is a structure that combines the initial reversal from a double top, immediately followed by a bearish continuation from the descending triangle. And both patterns reuse the same base of support, which unsurprisingly, along with these other levels, has retained considerable influence before and after the patterns have finished. Sometimes there can be a much more gradual decline instead of just one large break below the base of support, especially when upswing points are made up of relatively large candles. This can result in one large descending triangle formation that can be broken up into several descending triangles. Then there can be a decisive break below the base of support, but it's not unusual if it's a smaller break, like in this case, where a double bottom quickly reverses the chart back up. Here's a similar case, a steady decline and a defined base of support, which is not broken through, leading to a failed descending triangle defined by a characteristic 3 methods, rising candlestick pattern that still does slow down upon contact with the downtrend line of the descending triangle, and the resistance range made up of the highest swing points in the pattern. On the topic of trading ranges, they'll usually have more than 3 upswings and downswings, since they are often related to double and triple top, along with double and triple bottom patterns that will begin a horizontal range, either leading to a reversal or continuation. In this case, it's heading towards an uptrend continuation with a noticeable incline towards the end. Like other patterns covered in the lesson, the structure left behind by the trading range can be used to varying degrees later on to reference support and resistance areas. It's not too uncommon for a trading range to line up with clear swing points from the past, such as in this case, where there's actually a failed double top reversal that heavily concentrates a trading range in the 52 area. Next is a relatively compact trading range that can have its upper and lower boundaries defined by open, high, low, and close prices from multiple candles that are often aligned. Unsurprisingly, these are usually the candles that are larger and/or are clear reversal candles. The result is a break of the lower boundary quite similar to a double or triple top pattern. Sometimes portions of a pattern, like in this case with the declined reverse head and shoulders, certain swing points can retain influence well into the future, leading to wider trading ranges like this. This next example begins with some triangular features, which can be narrowed down into a horizontal trading range. After dropping below the lower boundary, just like a triple top upward retracements, will be resisted around that 23 to 22 range. Then down here, closer to the 19 to 20 range, there's a well-defined range in terms of the lower boundary offering support, in contrast to the upper boundary, which is much harder to define with less downswings consistently aligning with each other. This neatly formed horizontal trading range doesn't lead to a major bullish reversal, and instead better defines the beginning of a bearish continuation. Here's a similar situation in that lots of upswing points are clearly aligned with each other in comparison to the downswing points that instead produce a noticeable incline, essentially producing the opposite of a descending triangle that is neatly preceded by a 3 methods falling candle pattern, and preceded by a 3 methods rising candle pattern. Next up, the head and shoulders chart pattern, which in this case provides a wide yet well-defined range of resistance to reference from the neckline to shoulder level, where in fact a spread out double top forms to produce a further drop that's also quite significant. Next is a flatter formation, mostly just a horizontal range. The distinction is with a higher peak in the center, along with a defined downward slope developing to finish off the overall symmetrical features of a head and shoulders pattern, which in this case fails to break under the neckline area, and instead breaks over the well-defined downtrend line forming the right shoulder area, which leads to attention being focused around the resistance level stemming from the downswing point that forms the head. Soon, this 159 level is quickly surpassed, reversing roles to become key short-term support and finishing off a case where there's a failed head and shoulders pattern, leading to a well-defined bullish continuation. During the next major bearish move, which is incidentally from a head and shoulders pattern, the clear levels from the failed head and shoulders pattern can still be referenced for identifying a support range. Here's a variation of the head and shoulders pattern with an inclined neckline, which is followed by a strong drop characterized by the 3 methods falling and 3 black crows candlestick patterns. The 116.55 level defines the lower portion of the neckline being from the lowest swing point that formed the inclined neckline. This is forming a clear resistance range with the 115 level, which is just from an ordinary but well-defined swing point as well. Naturally, another strong drop takes place with those 3 methods falling and 3 black crows characteristics from the candle that follow the break of this more compact head and shoulders pattern, which also has a slight inclined neckline. And perhaps not too surprising, these levels become influential when recontacted. This even extends into the intraday time frame well into the future. Coincidentally, here is another compact head and shoulders pattern, this time in the intraday time frame. Especially in a shorter time frame, focus on the closing prices to form the main outline of the pattern, since there can be more volatility producing longer wicks in the short term. Now here's a head and shoulders with fairly standard characteristics other than the slightly flatter shoulders. What's more unusual is where it forms. It takes place when the chart is neutral to bearish instead of marking the end of a defined uptrend. But in this unusual case, it represents bearish sentiment quite well to continue the downtrend, with useful downtrend lines from the right shoulder lasting for quite a while after the neckline is breached. Horizontal levels from the pattern also retain influence for quite some time even after the pattern has completed. Over here, there's the general shape of a head and shoulders pattern with a larger right shoulder portion that ends in a failure to drop below the neckline area, leading to a bullish continuation. Here's a common situation where there's already a defined resistance range that has at least some of its levels run through some of the key parts of a head and shoulders pattern. Actually, this is quite precise, especially at the downswing point that forms the head, seeing as how the 1045 level almost runs exactly at the top of the real bodies of those two candles. In contrast, downtrend lines from the pattern have some influence, but aren't that useful overall. This would have been a head and shoulders pattern if it wasn't missing the right shoulder portion, whereas this is a head and shoulders pattern, but one that is comprised of smaller candles for the shoulders and large candles for the head instead of full swing points. Incidentally, this pattern is the peak and center of this head and shoulders pattern with uneven shoulders, but a fairly level neckline area. Like in some previous examples, the following downtrend doesn't follow the downtrend lines from the head and shoulders pattern. However, even before direct recontact with the neckline area, there's already some noticeable resistance. When the 153 to 154 range is finally surpassed, it reverses roles to offer support for several failed double and triple ranges that end up forming ranges which combine to form the general shape of a head and shoulders pattern, where the right shoulder is significantly sharper and smaller, compared to the flatter and wider left shoulder and head portions, that are all fairly well aligned on the still highly relevant 153 to 154 area that will be reused as the general neckline area. Now for the counterpart to the head and shoulders pattern with the reverse head and shoulders pattern, sometimes also called the inverse head and shoulders pattern, which in this case doesn't drastically reverse the long-term downtrend, but still does provide substantial support, especially around the shoulder level and the upswing point that forms the head, in the low 72 range where another reverse head and shoulders pattern forms. It isn't quite symmetrical and has a noticeable downward slope. However, these particular features don't detract from the bullish nature of the pattern and are simply variations to the reverse head and shoulder structure, which manages a more decisive break over 74 this time with a fairly moderate to steep incline. This next example is fairly symmetrical and has multiple swing points for each of the shoulders. Yet it still doesn't produce a major uptrend despite having these additional features that align with the neckline region. After all, it's not too uncommon for major swing points in the past to line up with the neckline region, just like the normal head and shoulders pattern. And if the pattern has a weak outcome, like in this case, there can be a bearish reversal pattern immediately after it finishes. In such cases, there will usually be a break back below the neckline, with the drop being more likely to continue falling until more substantial support is found around the shoulder level to head region. Dropping into the next example with a demonstration of a compact variation of the inverse head and shoulders, where there are mostly clear but small swing points. Alongside this abnormal feature that resembles the usually slightly neutral to bullish price action from the middle portion of a 3 methods falling candle pattern, it forms both the left shoulder and part of the neckline at the same time. There's the break above the neckline, immediately followed by a minor bearish retracement that directs attention towards the supporting influence of these uptrend lines from the reverse head and shoulders pattern, which gradually sustain the development of this uptrend to this steep acceleration. Now here's a failed double bottom that ends up marking the central range of a bearish continuation. With the recent rebound, the bottom boundary of the range becomes relevant once again. Expectedly, there's resistance, but contact is quickly reestablished with it to eventually break out. In the process, this less clear reverse head and shoulders is revealed. It has those features we discussed earlier that make the pattern harder to identify, but nonetheless it still has a clearly defined head and neckline area, which naturally becomes the focus of support with the retracement. Here's another example where the shoulders are comprised of minor swing points that are fairly level to form a clear neckline, though this is less symmetrical with more swing points on the right side where contact is quickly lost as a bearish reversal drops the chart down back to the head area. As soon as the chart began closing back under the shoulder level, the pattern was more likely to fail. Now attention will shift to the swing point from the head area around 66, which when broken through naturally leads to a strong bearish continuation lower. In such a case, this 66 level becomes a firm resistance level when it's recontacted. This next example starts with a similar situation where there's more contact with the right side. The number of swing points doesn't matter as much compared to whether the chart closes is over the neckline area or back under the shoulder level. Then, as usual, when there's a reversal of the uptrend, strong support potential starts from the neckline area going down to the shoulder level and the head area. Even when the formation of the shoulders is less clear, the head area will usually still be quite clear and present some familiar candle patterns. Here's the familiar break over the neckline advancing the uptrend. Now here's the situation where there's a potential double top immediately after the reverse head and shoulders has completed. Maybe a triple top now with a slight incline, or not because there's no return back under the lower boundary, which is also the neckline of the reverse head and shoulders. Instead, a bullish continuation takes off, and these patterns become useful landmarks in the development of the uptrend. As usual, one of the most important landmarks is the neckline area, which reverses roles between resistance and support several times. So there you have it, examples of the inverse head and shoulders pattern. Just like the head and shoulders pattern, it can have quite a lot of variation, especially with the shoulder portions and neckline area that can contribute to this being one of the more difficult patterns to use. Hope you enjoyed these examples and found them useful. Please stay tuned for more technical analysis examples. For more on indicators as well as Fibonacci methods, follow Ascencor. Thanks for watching and have a nice day.